You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means we are back once again. Time for the Advisor's Option, the program for you, the busy financial advisor or asset manager. Maybe you're options curious. Maybe you've already taken a few steps into those options waters, need a little help to go a little farther. Maybe you just want to stay up on the latest and greatest in the world of options. Either way, we got you covered here on the Advisor's Option. My name, of course, Mark Longo from theoptionsinsider.com. as well as from the network upon which all of you folks are having a very busy, very exciting, very interesting month, if I do say so myself. If you're just listening to the Advisor's Option, of course, make sure you're getting the full network wherever you're getting the show. It's available pretty much everywhere under the sun. And of course, if you want to go above and beyond, you are an advisor who has questions. There are quite a few of you out there. Then head on over to the Pro. You can ask those to anybody you like over there, theoptionsinsider.com/pro. Options oddities, live streams, giveaways, all sorts of fun going on over there on the Pro if you want to turn that options fun up to 11 here during the holiday season. And let's see who we're turning the show up to 11 with this week. First, let's go out to the shores of New Hampshire, where I am joined once again by the Otto Father, a.k.a. the Oracle of New Hampshire, a.k.a. the guy who's loving up some AI these days, none other than Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Matt, welcome back to the show, sir.
Just trying to fight off all the AI bots and keep humans as number one, Mark.
I'm glad to see you are early in embracing our robot overlords, sir. So when they come for all of us, they'll come for you last.
I come bearing gifts, and they know if you've been kind to them.
Exactly.
So you better be kind.
Exactly. They know if you've been bad or good. So be good to the robots, for goodness sake. And also joining us in the hot seat this episode is a newcomer to the program and indeed to the network. He is Katara, the founder and CEO of TappAlpha. Sai, welcome to the Advisors Option Program.
Great to be with you, Mark. Thank you so much for having me. I need to earn some of my own AKAs, but hopefully I can do that over time.
Yes, it takes a while. You got to go beyond the first appearance, and then we'll see.
Baby steps.
We'll see what the options gods have in store for you there. But Sai, as your first appearance on our network, as with all of our first timers, why don't you go ahead and give our audience a bit of an overview of your background in the world of options and derivatives, as well as what it is you folks do over there at TappAlpha.
Absolutely. No, appreciate it. So first swing of the bat on your show. Excited to participate. Love all things options. My background is actually coming from a different world. Computer engineer by trade, ran a software company for 17 years, and then ended up wanting to transition over to fintech. I've been an options trader my whole life, got bit early on the buy side, and so sort of flipped some of my strategies more to selling options than buying them, but just understanding what a powerful tool they are. It's something that I learned from my dad, actually. And so wanted to turn that into something that can help benefit others, and that's why we founded TappAlpha about 2 years ago. So we're a fintech company, just started a couple years ago, and we're also an ETF issuer that put our very first ETF on the market back on August 15th called TSPY, which is a zero DTE covered call strategy on top of the S&P 500, getting good traction and growing it. But it's been a ton of fun joining this industry from a totally different world. So glad to be here.
All right, then, with the gang all assembled, listeners, let's kick things off with the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
All right, everyone, welcome to the P&L statement, the portion of the show that was born out of the pandemic. We found ourselves every month looking back and saying, man, what the heck just happened? That was wild. And we kept doing that month after month. And finally, we decided, you know what? This probably should be its own segment on the show. Thus, the P&L statement was born. And since our last episode on the Advisors Option, listeners, a lot going on in the markets. Of course, the last time we all gathered here together on the program, it was still an unknown who would be in the White House next year. So there was a lot of risk, a lot of concern hanging over the markets. As, of course, a month later, thankfully, we do know now who the occupant will be. A lot of people were concerned, regardless of who won, that it would be a disputed outcome, and we'd see a lot of the tumults and just madness extending beyond Election Day. Thankfully, we did not see that. Markets really seemed to like that. We rallied the day of the election, which is kind of strange, and then we rallied hard the next day, and then the day after that, and the day after that. Vol was pretty much taken out to the woodshed. They put a bullet in it, listeners. Over the last week and change, though, we have seemingly settled out a little bit. Today we're rallying again, so maybe we will end up again back north of 6,000. Of course, he broke through 6,000 in the S&P. Then it seemed like the rug got pulled out from the market, started selling off a bit. Vol started firming up a little bit, and that's kind of where we find ourselves coming into this episode at the end of November here, listeners. S&P has been rallying the last couple of sessions. We are back over the 6,000 level, but of course, if past is prologues, could be just another head fake, or it could be the Santa Claus rally everyone is talking about. We're hearing a lot of interesting opinions out there on the markets and on vol right now. So let's get some more. Let's go around the horn. Sai is our guest. We will start with you, sir. Obviously, it's been a wild month here post-election. What's been catching your eye in the world of options and volatility, sir?
Well, it's been interesting, actually. We might as well call this Tariff Tuesday. As far as the policies there, just the announcements yesterday from the president-elect talking about an additional 10% tariff on China, 25% on Canada and Mexico. If you put those three countries together, that's 43% of U.S. good imports. And so when you think about the inflation fight, when the impact that's going to have, it changes the calculus a little bit. You know, one of the things that's been amazing with respect to options-based strategies, options, as we all know, are tied to volatility. The bigger the vol, the juicier the premiums. And so we're seeing that volatility get hit by some of the policy discussions that we're having. And that's one of the things that's actually really interesting from an options-based perspective, I think, for what we have ahead of us. But there's some big sector impacts that I think folks have to keep their eyes on when you think about tech, consumer goods, manufacturing, and then even the retaliatory stuff, thinking about agricultural exports to China. All of that is going to impact volatility, which I think bodes well for option-based strategies. It's just a matter about how we use them, how we implement them. And so that's one of the things I think we're looking forward to into 2025. And we'll see. It's going to be a challenge for the Fed to continue to balance interest rates and the fight with the inflation pressures that are going to be there. But, sending all the good juju to Jay Powell and the team there, and fingers crossed we can continue to keep inflation under wraps.
Yeah, you're right. It does seem like the market's really not concerned at all about the impending tariffs. Are rallying hard out of the gate on Monday off the news of who they think is going to be the Treasury Secretary. And now, of course, we have a little bit more insight into this tariff plan. And like many people, I was taught very early on in my econ classes that tariffs are pretty bad. And yet here we are, market rallying a couple of days in a row off the noise and the news of these tariffs out here. So apparently the markets, either they're whistling past the graveyard or they're not spooked at all by these massive tariffs coming in across the board and kicking off trade wars around the globe. But that's a conversation for another day. Maybe our new geopolitical show we'll have to add to the network out here. Not divisive at all, a show like that. Let's go out now to the shores of New Hampshire. Mr. Matt, you and I have talked a few times since the election on various episodes. By the way, listeners, if you missed the election night spectacular, Matt was on it. It was a great time. It was roughly 4 hours. So settle in. You could take it in chunks if you need to, but we had guests from all over the world on that. Nothing political at all. Just a fun time talking about the markets and options and volatility and the impacts therein. So check it out if you missed it. It's available on the network wherever you get this show. You and I talked on election night. We talked a few times since. A lot going on. You've been saying for a while now you're not feeling this rally. You've been, not to put words in your mouth, but I'm going to anyway. You said you're always bearish, but now you're more bearish than ever. And of course, the market heard that and just took its bit in its teeth to the upside, sir. So what are your thoughts on a few more days of green as you're feeling more skittish, sir?
Yeah, I just can't hate it anymore. It's like, if you look, first of all, let's just talk about what happened after the election. The put call slope finally came back down. My big thing about zero DTEs being a very good thing for the market. There were a lot of people buying puts and put the market makers in a pretty tough spot. But right after the election, the slope came back down to the part of the market where we've only seen since zero DTEs have been introduced. So that's happening. And, as you said, the bearish part, but there's so many indicators now like that we're in the last days. The copper to gold ratio way down. That's usually a, something that predicts business. And also the speculation on especially small stocks. So I have a graph of the IWM_C. So that's the components in ORATs. And those calls, Mark, are as high, and we haven't seen them this high since the GameStop days. So so people are people are just having fun, buying out of the money calls, watching these stocks rip up. I just, as a guy that, I love this market, love for it to go. I always have protection, but especially now, it just seems like there are a lot of flashing red lights all over the place. A lot of volatility indicators now starting to weaken. Gosh, Bitcoin has hit almost 100,000 and now it's come back to 93. It just seems like things are just so far up. I'd be very protected if I was bullish now, Mark.
Speaking of that protection, you're always talking about your put calendars, but does this go beyond that now? Sounds like you're feeling more bearish than normal, so a little put diagonal is not going to do it for you. You going straight puts, put spreads? What are you up to, sir?
No, you still have to until the market tells me something. I mean, they're flashing lights, but if we're rallying, you can't just go straight puts. They're too expensive. So I've been doing put calendars. There's some, pretty nice ones out there right now, kind of long term with a shorter term. I'm talking maybe like, 400 days, 100 days, 300 days, 150 days, like those types of things. So so if the market heads down there, you're going to get a big volatility help. And, still there's value in those 150-day way out of the money puts, 10 delta I'm talking. So you could still collect some theta even and still have protection. So I'm not, I'm not at my 2008 when I was just buying every single cheap put and made, that's when I make a lot of my money in the big corrections when people don't really know how to trade those things. But I'm not straight out buying puts. I'm not even buying put spreads. It's still the calendars until people start to wake up, get the hangover from the punch bowl, and see that a lot of these rosy pictures everything has to happen perfectly in order for this market PEs to continue. So when people start to recognize, I think it's going to be a little bit ugly, Mark.
All right, so you're concerned, you're perhaps more skittish than you have been in the past, but not quite. The alarms aren't blaring yet. You got to let us know when the alarms are blaring, Mr. Matt. We'll do a special buy straight at the money puts episode. We'll bring you on just for that moment. But you did mention zero DTE, a very pertinent topic, which leads perfectly, sir, to our tricks of the trade segment.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, listeners, welcome to the Tricks of the Trade, the portion of the show where we, like the man said, we explore some practical ways to use options. And one of the questions we've been getting a lot these days has been about that very near-dated portion of the option spectrum. In particular, zero-day options. Matt is a big fan of them. He's talked about them a lot on this show and other shows on the network. We've gone back and forth about zero DTE on just about every show now, the option block, the volatility views, you name it. Near-dated zero-day contracts, kind of the talk of the town. This month's segment was kind of inspired by a question. Usually we would save this for the office hours, but it was so germane, we bumped it up here to the Tricks of the Trade. This question came from 88 Harbs. Hope I'm pronouncing that correctly, Mr. or Mrs. Harbs. They want to know, they said they're a recent convert to the network here. Well, welcome. You are far from alone, 88 Harbs. They say, I've been learning a lot about how to incorporate options into my workflow. I've heard Matt's comments about zero DTE and wonder how you think an advisor should go about utilizing them for their clients. Man, we could do several episodes, several hours about this topic. It's a fun one. But that's a great question there, Mr. 88 Harbs. And we have a great guest to kick things off here. Cy, as you mentioned at the top of the show, you spend your day, day in, day out, when you're not talking to us, in the zero DTE world. You like them so much, you created an ETF all about it. You kind of gave us a little bit of the bullet points. Let's go a little deeper now. What is this TSPY ETF that you created, and how do you go about selling the zero-day options for it?
I should get some t-shirts made. I heart zero DTE because these things have been a game changer. And I'll tell you how it all came about. Back in October of 22, I ended up transitioning out of the company that I was with for a long time. Always been a buy and hold investor. Time in the market was always my game. But when I left, I had to find ways to make ends meet. And I don't know if y'all remember, but in October of 22, the markets were down. And so I didn't want to have to liquidate any of my SPY shares in order to sort of pay the bills. And so my dad had taught me about covered calls, but the perfect storm that happened right in that same time frame was zero DTE options were now available on 3 indices, SPX, on the Qs, and on the Russell. And I said, well, perfect. I'm an SPY investor. Let me try it and see if it amounts to anything. Well, fast forward 2 months, and just the options premiums on top of still owning the underlying equities, I was able to cover the lion's share of our mortgage. And that blew my mind. And the other thing for me at that time, 4 months from that date, when I left my last company, we were going to have our first baby. And so that financial pressure that you feel of how am I going to make all this work in this time of a transition? Well, this was the answer for us. And the financial relief that it provided me and my family was something that I was like, I've got to find a way to share this with other people. But the catch was when you're doing zero DTE options, it is work. Like I was putting in 3 to 4 hours a day because I did a lot of math to figure out where my risk profile was, where I was comfortable to take a position, and tracking that to make sure I could improve on my strategy over time was difficult doing it manually. And so with the software background, I ended up writing some tools that helped me take that strategy and automate it. And it took 4 hours down to 3 or 4 minutes a day. And I was trying to figure out, this is unbelievable. It's so helpful. How do I share this with other people that need the same kind of benefits? And so I ended up meeting some people in the ETF industry, and they're like, you should just take this and wrap it in an ETF wrapper and bring it to market. And I did some research on it, and there's some real benefits to the ETF wrapper, especially with hedge strategies like this, which we can get into the tax stuff later. But that's what ended up inspiring me to sort of build TSPY and launch it out in the world. And the goal has been, we're really hyper-focused on total returns. We're to the advisor community out there that's trying to figure out how do you use these strategies. Number one, I don't recommend doing zero DTE manually, especially if you have 100 clients. Imagine trying to do that at scale. So there's ETFs that are out there that can help. There's other investment vehicles that can do it. But if you can actually package this as a core equity with an income kicker, that's one way to think about it. The other way to think about it is, who knows what interest rates are going to do? They've been on a downward trajectory. But if you're looking to replace fixed income, that's another way to put it in your portfolio. And then some advisors look at it as sort of a tactical alt, where since you're using zero DTE, you can put it in a sleeve that allows you to sort of get different exposure with actually lower beta than what you're dealing with just the pure market, to really give you a flexible tool for your clients and customers. And there's 3 reasons why zero DTE is unbelievably powerful. Number one, we did the math. So if you took a 30-day just traditional covered call option strategy at a fixed risk level, say 25 delta, and you took the premiums and call it X, and you took that same strategy, but you just wrote zero DTE at 25 delta over that same period and you added it up, the premiums that you get are between 4 to 4.5 times the amount that you would get for the same risk level. So if I'm an investor, when I was deciding what to do when we were launching TSPY, if I'm taking the same risk, I've got 2 bridges with crocodiles under me, and at the end of one bridge is 1 bag of gold, and the end of the other bridge is 4. I'm going to take the bridge that has 4 because it's the same risk, but the reward at the end of the day is significantly more. That's one of the big reasons why we can get, especially as vols go up, you get really juicy premiums because of the high demand and high volume of zero DTE options. The second thing that I didn't think about until I really got into this, why does true zero DTE matter so much? Because you write them in the morning and they expire same day. Guess what your short position completely avoids? Overnight risk. That's when earnings happen. In the mornings, that's when macro data comes out. And so if you can keep your long exposure, but you minimize the short exposure for those big swings that can happen after market close, it's way easier to mitigate risk, to make sure your option position stays within your current risk profile that you're comfortable with. And then the third thing, being a math nerd, if you have more granularity, you got 22 at-bats every day to reposition your strike versus if you have 1, you could much more closely mirror the underlying equity growth of whatever benchmark you're using. And when you put those 3 things together, you create a really powerful tool for people that need income for today, but capital growth for tomorrow. And that's the balanced sort of approach that I've found great success using zero DT options to sort of create value for our family and now hopefully for other investors in the market.
All right, a lot to unpack there. As you mentioned kind of at the top of the show for our advisors who are maybe struggling to follow along with this, this is effectively long SPY listeners. And then, of course, you're adding a covered call component to it. And that's effectively it, right? Side, there's no other income components. You're not selling put spreads or anything like that. It's just a covered call, right?
Keeping it simple. Yep.
And you mentioned the strike selection. I'm sure there's a lot of voodoo that goes into it. You use the very stereotypical example of the 25 delta. We like to get into the weeds on this show. How do you go about calculating the strike on a daily basis? Is it something as simple as approximate 25 delta or one standard deviation away, or are there more factors to consider?
So many factors go in, and that's actually where the underlying fintech comes in to make it so your head doesn't explode. It can do the math for you, but it takes in volatility, it takes in the Greeks, it takes in, the big one is calendared events. So when those things occur, it takes in volumes. All of that data and information really gives you the choice, and it spits out to the portfolio manager or ultimately the advisor in the long run, showing you risk versus reward. So you see how much you get paid and what's the probability that this is going to go against you, and you can decide for yourself based on those dynamic inputs. And that's the other thing that's really important about doing this. It has to be dynamic, because if you do a static position and you do a set it and forget it, it's really hard when you're trying to take into account some of these events that occur. So like the days that Jay Powell speaks, you think about the gap between your strike and the actual market, you could be up to 1.5% out of the money if you're trying not to get assigned or called away. Versus on days where it's a nothing burger, like this week is supposed to be quiet, Thanksgiving week, but we're seeing the market rip. You can play it a lot closer to what the core strike is to the market price, because those same movements don't occur. But you've got to be able to have some method to judge dynamically where is your comfort zone in comparison to where the market is, and that's the name of the game. And the other most important things to listeners out there to really keep in mind, so we target 80-20. 80% of the time, those options are going to expire worthless. So we keep all the premiums. But the 20% of the time when they don't, when things go in the money, that's where you win or lose this whole game. And you've got to have a really strict and disciplined risk management capability in order not to get way upside down on these things, because otherwise you're going to start trailing the market if you're truly looking for a market beating opportunity.
So just to follow up on that, in that scenario, would you roll then? Would you let your underlying get called away and then just rinse and repeat? How do you go about, as you mentioned, what is the secret sauce for making sure you don't get run over on those 20%?
Yeah, there's a couple ways to do it. So for example, if tomorrow is like a tier 1 event, tier 1 would be like Jay Powell speaking. There's no way that we roll, because the movement could really blow us out of the water. So in those days, you just take your licks and you put a stop limit and you prevent yourself from losing too much with respect to buying back the option to close it out. On other days, one thing that's unique, it's hard to do really dynamic trading, typically in a 40 Act product inside of an ETF. But we found a way to do it. And a couple ways, the reasons for that are, number one, we actually own the true underlying shares of SPY. We're not doing synthetics. We're not having to roll those. And then two, we have a process that makes it really dynamic, so we can actually do multiple trades in a day, where a lot of ETFs are sort of hamstrung. So having the flexibility to do rolls, I think, is a pretty unique thing. And that is a really important tool to have in your toolbox when you're trying to be defensive in cases where the market goes against you. If you can roll to the next day, you buy yourself some time. We'll typically do a diagonal roll. We'll add a day, and then we'll add to our strike so that we have some more headroom in the hopes that we can get back, from behind the 8 ball in certain cases. So that's a really important component to these strategies, just to make sure the defensive pieces and the risk management side is there. Otherwise, you can get upside down pretty quickly, and it gets pretty ugly pretty fast unless you have a way to mitigate that.
Well, I'm glad you mentioned the systematic approach to zero DT. It's one of the reasons why we wanted to have you on the show this month, because I think realistically, for most of the audience of this show in particular, there's a lot of active retail out there who want to roll their own, who are very comfortable and have the time to write 0-day options every day, and that's their game, and more power to them. For a lot of the financial advisors out there, it's not realistic if you have more than a couple of clients to implement these strategies on a daily basis. I mean, we've heard pushback for years. This show goes back a while, over a decade now, I do believe. And even from the earliest episodes, we heard people pushing back even against writing calls on a monthly or quarterly basis. They said that was too much work for a lot of the advisors out there. So writing calls on a daily basis, yeah, that's a non-starter for most of the advisors in our audience. And we've heard that from them. They've written in saying, hey, I love all this stuff. I just can't implement that. So for a lot of them, realistically, they are going to need some sort of systematic approach. Maybe it involves an ETF like this that will do it for you. Matt, you've been one of the bigger proponents of all things zero-day that I know, and certainly have been for some time here on the network. It's always been a clash, though, when it comes to this show and the audience of this show, because you know, you can talk about all the benefits of it, but for a lot of the advisors out there, they can't really practically take advantage of them. What are your thoughts on the question that 88 Harb sent in? Let's start there. He actually mentions you. He said, I heard Matt's comments about zero DTE and wonder how you think an advisor should go about utilizing them for your clients. Mr. Matt, what do you have to say here for 88 Harb, sir?
Yeah, so firstly, indirectly, advisors are benefiting from the skew being a little flatter. So it allows more protection even on the outer positions, because the market makers are now trading both ways and are able, with all the added liquidity, to flatten their books out, where their books have normally been short puts and long calls because people are selling calls to them. A lot of overriders are selling calls to market makers, and so they have a lot of long calls. And then people protecting their books, like big banks and such, are buying these out of the money puts. So the skew, that causes an increased skew in the index products relative to other products out there. So what the zero DTE is doing is flattening out that skew. So advisors can benefit from the zero DTE just indirectly that way by having a flatter skew, you're being able to get protection for less money. But I agree with Cy that you need automation. Now, you could either get automation with a product or with trading it yourself. Now, obviously, it's difficult, for the paperwork and all that, but there are some good automation tools. ORATs, we work with companies, so there are a lot of very good technical companies out there that can auto trade. That we have clients that are auto trading. ORATs does tie into the broker's API, so a lot of the brokers have APIs now and allow auto trading through their brokerages. ORATs, we haven't gotten into that because it's a pretty crowded market. Actually, there's maybe tens of them out there where you can auto trade. Now, the big trick, in my estimation, is getting the right strategies. And it sounds like Cy has done a lot of that hard work with the testing. But we always say to back test and back test and back test. ORATs, we have every minute going back to August 2020 and every 2 minutes going back to 2015, and we test on all those data points. And we have the thing that differentiates ORATs is that we have indicators and we have summarizations and constant maturities and what's the delta 5 implied volatility. Like when I looked up just recently that the component weighted average of the Russell is way high. I could see that because and we're calculating that almost in real time. So these are indicators that should accompany a strategy. So for example, if there's one of the things that Cy does is looks at announcements. Well, not only announcements, but often the implied volatility sees other things out there. So when I intraday, if IV spikes, that could be another time that you might not want, or you might want to adapt a strategy. So the point that I'm making is it's not just a lot of people without a lot of good indicators, like some of our competitors and such, are using things like day of the week and time and all that. But if you can get some good indicators and look at what the market thinks is upcoming, we found in backtesting that those are at least as important as kind of looking at the economic calendar and looking at times of the day and days of the week. That's what people are, they have to use something in some cases. Often they're overfitting back tests. That the people that we see our competitors using, I see a lot of overfitting out there. But if you get some very good indicators and get a good back test, then you can implement that back test with a lot of automation, and that automation allows you to the time to actually do it. So the work that you do is on the back testing, and then testing a lot of the systems. But yeah, you're going to have, in order to really compete now, and I think one of the reasons that the volumes are up so high is all this automation. So people are automating their strategies and are able to test those out and implement strategies in order to pick up a lot of what zero DTEs have to offer, and that's the risk premium capture on a shorter and shorter time frame, Mark.
Yeah, it is fascinating to see how just pervasive zero DTEs have become. I was down at the FIA conference I mentioned on the network last week. The entire derivatives market descended on Chicago listeners, and I was pulled aside by someone who does a lot of quantitative work in the futures world and puts out a lot of data on that side. And he said even he's been lured into the world of zero DTE option writing in the equities, and how that's actually eating into his actual day job. He can't do a lot of his data he used to do because he's so obsessed with the 0 day, but he says it's actually been great for him. So people from all walks of life, all areas, even outside of the equity world, listeners, are getting lured into all things 0 day. But I think we've said it before, we'll say it again on the episode today. If you are going to implement these as an advisor, you do need some sort of systematic approach at the end of the day. It doesn't really make sense logistically or at scale to try to come in every morning and calculate new strikes and implement all the positions and then roll or close them, whatever you're going to have to do. Whether it's this new ETF out here, TSPY is the ticker. If you want to check it out more, listeners, or maybe it's your own automated solution, whatever the case may be, you're probably going to need some sort of systematic approach here to deal with this hot new thing known as 0 day. And Cy, you mentioned some of the things that really are attractive to this. Of course, the no overnight risk really is a seller, I think, for a lot of people in the 0 day world. They get to play during the day, and then they're done. They can go on about their lives, whereas in the futures world or in the crypto world, a lot of people now are starting to get exposed to overnight and weekend risk, and maybe they don't like it. Maybe they like sleeping at night. So the 0 day world certainly has its benefits there. You also mentioned some tax benefits. Let's hit on those really quickly. Obviously, we're not a tax show, but that is an important area for a lot of our advisors. What are some of the tax benefits you referred to here for TSPY?
Yep, absolutely. But not an advisor, but the two places of value for zero DTE are, number one, there's the options premium income that comes in, and number two, there's the equity growth of owning the shares. Starting with the options premium income, we're trading SPX, which is potentially a 60% long-term tax categorization and 40% short-term. A lot of people do that. And that's really good also for commissions because it's 10x the notional value of what the SPY shares are. So you have to trade 1/10 the contracts. And when you're trading it every day, that makes a big difference over time. So that's number one. Number two, this was a huge learning. And again, ask your advisors, tax accountants about this. But when I was doing this in my individual brokerage account myself, when you have a covered call position, the IRS calls that a straddle. And one thing that's really interesting about a straddle is the long-term capital gain clock gets paused on the underlying shares that you're straddling. And so if you buy shares and you do this every day like clockwork, even if you own the underlying SPY shares for more than a year and you ultimately sell them to realize the gain, all of that gain will be treated as short-term capital gain, which is a gut punch. But if you do this inside the structure of an ETF, this was fascinating to me when we figure this out. If we're not realizing the gains within the ETF and somebody holds TSPY, and again, please talk to your accountants about this. I am not, I'm not an accountant, but if somebody holds TSPY for more than a year and the fund does not actually realize the gains of SPY over that year, when somebody sells TSPY, let's say 18 months later, the fund takes those shares and hands them back to the bank in kind. ETFs have this magical tax benefit called in-kind redeems. And what that means is that short-term categorization on the underlying capital growth of the SPY shares goes away, and the end investor only has to pay long-term deferred capital gains on the underlying shares of the SPY. That is a huge thing when you're thinking about long-term buy and hold products like TSPY. And if you hold that, we did the math, it was something like over 10 years, the exact same returns. At the end of 10 years, with these tax benefits, you end up with something like 45% more after-tax capital because of those categorizations. So again, do your own tax research, but it is a big deal to be able to do hedged positions within the confines of an ETF vehicle because of in-kind redeems.
Wow, who knew the ETF wrapper could be so powerful from a tax perspective? So there you go, listeners. Maybe a little added ammunition if you were considering doing this yourself. Maybe the tax benefits of an ETF will lure you to the dark side. Speaking of the dark side, listeners, some might view earnings season as that. I guess we'll find out. Is it, listeners? It is time for the earnings volatility report.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, listeners, welcome to the Earnings Volatility Report. Another segment born of the pandemic because Matt and I were just stymied at how little earnings volatility there was. So it seemed like someone should calculate that, and thus this segment and our ORATS reports were born. And if you've been listening to the show for a while, you know that, I think to put it mildly, the cycles have been explosive from a volatility perspective. Each cycle for the better part of the last year and change has been outperforming the one before it. Very explosive. Our long-term average, which again, I say long-term in quotes, it's 12 quarters. So it's a trailing 12 quarters. It would be fascinating to go back. We have been crunching this data for longer than that, obviously. It would be fascinating to go back and get an average for all of it. But for 12 quarters, it is at 114%. The current season, listeners, hanging out pretty close to that level, 113%. So still pretty explosive. I'm looking here right now. I don't see a single week of the 6 weeks that we calculate, listeners. I don't see a single week below 100%. The closest was 101% in week 4. Everything else has been just off the charts. 126% this week, 124% in week 3, 121% in week 2. And so on and so forth. So, Mr. Matt, this has kind of been our narrative for a while. We've been wondering, when or if the worm might turn. We kind of thought maybe this might be it. It might be hard to sustain this level of outperformance, but so far it seems like that's not the case, sir. What are your thoughts on how this earnings season is shaping up right now, sir?
Yeah, our rule of thumb that we've discussed over the years is that when you have a large economic macro event, in this case, the election, that usually hurts the movement for earnings. What you want is nothing much going on and earnings, people to focus on earnings, and they really move a lot of these stocks post-announcement. And this is what we've seen this earnings season, Mark, as you pointed out. Owning a straddle has, again, paid off. We were so many weeks, years call it, when it wasn't during COVID and that when the vol was relatively high and people weren't really talking about earnings. But people are, this tells me that people are focusing on earnings. There's a lot of guidance problems that I've seen out there. So the people that are hitting are paying off, and the people that aren't, they're punishing. So it's been another interesting earnings season that we're putting a bow on, and we'll start the next big one in January, Mark.
So far, as you're crunching the data, any surprises, any outliers really standing out to you, sir?
NVIDIA was interesting because it was really their guidance that moved that stock, but they didn't move that much. This is going to be an interesting one. Is it tonight? Yeah, it's tonight. SMCI. They've had a ton of accounting issues. The stocks rallied when they said that when your accountants leave you, Mark, and you're a public company, not a good sign.
Yeah, usually not a good sign.
Yeah. And so they're coming out tonight, and the shape of their skew is really odd. It's flat when you usually see a ton of backwardation, meaning the front months are higher than the back months. But theirs is pretty flat. So I'm going to be very interested to watch that one. And the stragglers, they come in, they're interesting coming in. But it's just the overall, another good season for option owners this one, Mark.
And Cy, I'm curious for you. You're obviously out there calculating 0 DTE options premiums. So the day-to-day fluctuations during times like earnings season, probably not a bad thing for you folks out there to generate a little bit of extra juice. How much of a driver do you find earnings season and potentially individual earnings events as a driver for calculating those premiums over there in TSPY?
Juicy and delicious, especially when you're talking Mag 7 or top 10 holdings in the S&P 500. You see meaningful movements, and you can use those in one of two ways. One, you can actually, keep your gap between your strike and the market price similar and just collect the extra juice if that's your game. Or in my case, we're sort of creating more of a low to moderate risk profile vehicle. We use that extra juice to buy ourselves some more headroom. So there's more volatility. We create a little more space because we're slow and steady wins the race. We're out there, we're harvesting little bits of option premium every day, and we're putting that in the bank. And that slow and steady wins the race has served, this strategy really well. And so those days, they have big impacts with respect to what the premiums look like. They have big impacts, as to what the risk looks like. And the main part of this game is just deciding where the match is between risk reward and what your comfort zone is. And so that's how we use sort of those bigger vol days, those bigger premium days, as we buy a little bit more headroom in order to keep our slow and steady wins the race philosophy intact.
Let's see if the options market won the race yet again in October, listeners. It is time to get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everyone, welcome to The Buzz, the segment where we break down some of the biggest, most compelling option stories that you may have missed because, hey, you're busy dealing with clients. I get it out there. And one of the ongoing narratives we've had on this show, definitely for the last 4+ years, has been this explosion of volume in the world of options. And can it continue? And so far, the answer has been a resounding yes, week after week, month after month, year after year. We do have the numbers now for October in a few days now. Hard to believe. In a few days now, we will have the number for November. And was October another banger month, another explosive month for the overall world of options? The answer is yes, but kind of you have to peer into the weeds a little bit to see what's going on. Overall options volume up 13.3%, over 1 billion contracts, 1.1 billion. That seemed unobtainable just a few years ago. Like 1 billion contracts in a month. Now it's fairly routine. People take it for granted now, but just a few years ago, the entire industry did under 4 billion contracts, like 3.5 billion. Wasn't that long ago. So now to see over 1.1 billion going up in a single month, again, that kind of shows you what a sea change has gone on in the world of options, thanks to ETFs and funds like TSPY and others out there utilizing options on a much more aggressive basis. This level of uptake has been just overwhelming, on top of course, the retail and everyone else really diving in over the last 3 to 4 years. Now, as a result, we're seeing equity options, so these single stocks you love out there, listeners, really accounting for all of that growth. Equity options were up 39.7% from October of a year ago. 421 million a year ago and 588 million, closing in on 600 million October of this year. So a banger month for equity options. Interestingly enough, the things that have been carrying the market on their back for the better part of the last 2 years, what we've been talking about all episodes, 0 DTE, aka index and equity and ETF options, I should say, not so much. Index options actually down October from October of a year ago, down nearly 8%, 7.9%, and ETF options down 6.3%. So those were actually two black marks, but they were overcome by just the tsunami of growth in single stocks out there. So interesting stuff. By the way, if you're wondering, how about futures? And when you're talking futures, what they clear at OCC is mostly VIX futures. You might think leading into the election, maybe some action on those. You would be wrong. VIX futures off 33%. So it was kind of a bloodletting across the board with the exception of equity options. But at the end of the day, that rising equity options tide was just too strong. It overcame everything else, and total volume was up 13.3% and hit 1.1 billion for the month of October. That, of course, puts us to 47.5 million contracts a day. That's the average right now through the end of October. That's up 7.6% from a year ago. So things are still looking rosy here for the year. Mr. Matt, this has been kind of a narrative we've been talking about for a while. This growth rate is obviously explosive last month, but also maybe a little surprising that the index and ETF options didn't really keep pace, sir. What are your thoughts on that? Are we seeing some chinks in the armor?
Well, yeah, I mean, that was actually a little bit shocking to me that equity options, and that's what I talked about a little bit at the top of the show, where that skew in calls. So, I mean, people are just jumping into some of these stocks. The top ones, NVIDIA, Tesla. I mean, Tesla had a huge move around the election. And then Super Micro has just been crazy, almost 1 million a day. Palantir still kicks in a lot. Amazon kicks in a lot. MicroStrategies. I mean, so a lot of these ETFs around Bitcoin and around AI. Some of the stocks have been really interesting, Mark. Usually we've been seeing just the zero DTE carry everything, but now some of these individual names, especially the high tech, especially the ones with stories around them, are carrying the day.
Sai, you picked an interesting, some might say an auspicious time to launch an options-oriented ETF. Obviously, you launched it back in August, so only a few months under your belt now. But of course, this is a hot time. Just a year or two ago, if you had tried to launch some sort of options-oriented fund or ETF, I think you would have got a lot more pushback than you're receiving today, where it seems like they're just all the rage. These are spinning up all the time. No small reason why these numbers have been so explosive month over month and year over year in the options market. I'm curious for you, as you mentioned at the top of the show, you're kind of viewing the options market from the outside. Was this a narrative you were aware of, this explosive growth of overall options volume? And is this one of the reasons why you decided to launch your options-oriented ETF now, or is this kind of just a happy accident you stumbled into, sir?
It gave me comfort, just seeing the explosion in zero DTE, because one of the things you look for when you're launching funds is liquidity. You want to make sure there's a market for what you're doing, and that's also why we ended up picking SPX as the index, because number one, the underlying, highly liquid for the equities, and then it's also the most traded typically of the options, zero DTE market. So you put those two things together, and it's the perfect combination at the perfect time. Sometimes stars align to get a brand new ETF out there, because you can test the theory, prove the model, do it in a public fashion with transparency through ETFs, and actually show that the zero DTE option market is resilient, even through all of the ups and downs that we've seen over the last 3 to 4 months. It's such sort of a perfect stars aligned opportunity, especially as there's hopefully going to be more conversations about interest rates going down. We'll see what happens with inflation, but how do you replace some of that income? Well, you see the popularity, the stability, hopefully in the options market. All those things put together create a really opportune time to launch strategies like this. And then the big question next is going to be single stock zero DTE and what happens there. And so the jury's out at this point, but I know SIBO is talking about it, and that's sort of the next, I think, horizon that people are looking at with respect to zero DTE.
I do have bad news for you on that front there, Sai. I was just at the FIA conference last week, and they had a big panel all about it. Our buddy, Mr. Henry Schwartz, the flow master, was on it from SIBO, and a bunch of other people from different international clearing firms, other things like that. And when the moderator asked about that exact topic, the prospect of bringing in single name zero DTE options, something I have been pressing on at all the different events for the better part of the last year. One of the panelists just yelled no, and very loudly. That was their response from a clearing perspective. So that didn't really give me a lot of confidence that we're going to see them anytime soon. There still is a lot of pushback, all this rigmarole around contra exercise orders at the end of the day. Should they exist for these? Should they not? Should they be cash settled? Should they not? Seems like there's a lot of behind the scenes shenanigans that still has to go on to really figure that out. So I don't want to throw cold water on you, Cy, but unfortunately it doesn't seem like we're going to be seeing our 0-day NVIDIA and Tesla anytime soon. But you know what we can see in the few minutes we have remaining, listeners? Time for a little bit of your questions. It is time for the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody, welcome to the office hours. We did cheat. We already featured a question earlier on in the Tricks of the Trade. We have time for maybe 1 to 2 more. Let's go out. This one, T-Vol, is very timely. I do want to hit on it now because it's all the rage. Outside of 0-day, what else is everyone obsessed with right now, listeners? Well, it's crypto. And T-Vol has a question. He says, hello. Greatly enjoying the Advisors Option Program. Well, thank you very much, T-Vol. He says, I would like more information on when I will be able to utilize the options on IBIT for my clients, please. Thank you. Well, T-Vol, you have great timing. It's frustrating for me as someone who puts out content on this all the time. We do our crypto rundown show every Monday, and of course, no sooner did we turn off the microphones last Monday than the IBIT options were approved, and we are now off to the races. And so I'm pleased to report, T-Vol, that you now can officially trade IBIT options for your clients, listeners. If you're not familiar with this, listeners, this is, of course, the much anticipated spot Bitcoin ETF from iShares there in BlackRock. Of course, the ETF was approved back in January. Took the better part of a year for the SEC to finally be comfortable with folks trading options on this ETF, and trade them they are. Right now, the ADV skyrocketing. It's been live for a little over a week now, and the ADV is already up to 319,000 contracts a day. We saw it do even more on multiple days out here. Over 250,000 contracts on the tape so far today, and the session's still got a ways to go out here, so probably going to blow through that ADV again. So folks are loving it. Interesting point as well that we did mention on the crypto rundown yesterday. So if you're intrigued by this, T-Vol and everyone else, I encourage you to check out that program. We did a deep dive into it, but one of the fascinating things, one of the interesting things really, is that we talk a lot about options skew on the Bitcoin and Ether options, and of course the volatility, the term structure, all these things on that show. And now seeing IBIT doing so much volume that it does really line up very well with what we're seeing out there on Deribit, which is great news for a lot of people who've wanted to trade Deribit forever, but you were in the US, you couldn't do it. IBIT is turning into a great surrogate for that. It's got volume, it's got liquidity, the term structure, the skew, everything else is lining up very similar to what we're seeing on Deribit. So clearly there's an ARB going on there. So if you are intrigued by that, you've been listening to that show, you've been saying, man, I wish I could play in those waters. Deribit just off limits. Now you do have your option, pun intended. Mr. Matt, you and I have been talking about crypto for a long time. This is the moment a lot of people have been waiting for in the space, especially from an options perspective. You know, you had your BITOs and you had options on those, and they, of course, tracked the futures, and they have all sorts of dividends and everything else going on. But there was nothing really optionable on a straight spot side. Now we finally have it. Seems like it's off to the races. Mr. Matt, what are your thoughts?
Yeah, it looks really nice. The skew is great. The market width in vol points that we look at is much tighter than BITO. The confidence, we do a confidence between 0 and 100%. It's way up there. Our scans, we're finding pretty tight markets. It's liquid. It's averaged 280,000 a day for the last 20 days in volume. It is the real deal, Mark. So pretty exciting to have it up. It looks great on the ORAT's dashboard, and I think it's going to be a nice product.
Sai, I know you're busy calculating the zero DTE options for your brand new ETF, but I'm sure you've at least noticed the groundswell of interest in all things crypto and indeed the IBIT options. What are your thoughts here for our listener, T-Vol, who's intrigued about maybe using them for his clients?
Feverish. People are clamoring for all things crypto right now. And it's, I have to admit, it's not my game. It doesn't fit my risk profile, but just watching everybody jump in the market has been fascinating. And now that there's options available on it too, we're just going to see more and more of this create a foundation of crypto as sort of a valid ball game, especially with the next administration that's coming in. So it's fascinating for me to watch from the sidelines to see how options are going to play in this market. But man, I'm watching volumes go through the roof. We partner with some ETF companies that are doing levered MicroStrategy and things like that. And it's a game that I'm not comfortable playing, but more power to you, to the people that want to jump in the pool.
Yeah, a lot of fascinating stuff. So T-Vol, good news. You can go out and do it right now. So let us know what you end up choosing. That, unfortunately, listeners, that music means we are out of time here on the advisor's option. But a fascinating discussion. Man, we hit on a lot of the hot buzzwords right now. 0 day, the crypto options, you name it. We talked about it on the show today, listeners. Sai, you did an able job for your first time in the old hot seat on the network. How was it, sir? Did you have a good time?
I had a blast. Thank you guys for having me. You guys made it easy.
And Sai, if folks want to learn more about all things TSPY, where should they go? What should they do?
Check out TappAlphaFunds.com. That's a good spot to look. And we've got our third distribution coming out next week. X date is December 4th. So take a peek, learn a little bit about it, and feel free to reach out with any questions. Would love to answer.
Ooh, dividends. I know that's going to appeal to a lot of the advisors in our audience. They like a little bit of cash flow. Side, go figure. So check it out, listeners. That ticker again, TSPY, TSPY, if you are intrigued. And Mr. Matt, you folks are always cooking up intriguing stuff over there in the land of ORATs. What do you have coming down the pike for our listeners, sir?
Yeah, I mean, Otto's doing great, and we're giving him more and more leeway. So we're going to have him looking at some of our back tests. So you'll be able to ask our AI Otto about some back tests. And of course, we have integrated live data with Interactive Brokers, TradeStation, Tradier. You can copy trades right into Schwab. That's what I do quite a bit. Scanning on indicators that are proprietary, a bunch of alpha generation. So come on over to orats.com. Look me up, Matt at ORATS. Mark?
I blame you for reminding me that SMCI is after the bell tonight, sir. So now I'm looking at charts while we're talking and options chains for SMCI. So you're dragging me down a dark path, Mr. Matt. But if you too want to be dragged down the dark path, maybe by Otto, the rogue AI, and check them out over there at orats.com, ORATS.com, listeners. The place to go to kick the tires and light the fires. And while you're checking out things online, make sure you check out our friends over there at the Options Industry Council, optionseducation.org, the place to go to learn more. That's going to do it for us on the advisor's option for this month. Hope you're having a great trading month. Hope you have a good holiday if you're here in the U.S. If you're not in the U.S., hey, just have a great week. We love you all out there. Stay safe out there, and we'll see you back here next time on the advisor's option.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development. making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.